Disney just posted a monster earnings number, a nearly $3 jump in EPS, but it didn't come from the booming sales. It was a one-time tax win. Here's what the following really says, and the one thing that still worries me. The big picture. Let's break down Disney's latest report. On the surface, things look steady. Revenue was about $23.7 billion, up a modest 2% from last year. But then you see the headline number. EPS, earnings per share, jumped to $2.92. So how does a tiny 2% sales jump lead to a massive earnings beat? This is your first clue. The kicker is that Disney got a $3.3 billion non-cash tax benefit this quarter related to its purchase of Hulu. It's a one-time accounting move that makes the quarter look spectacular, but it's not repeatable. If you strip that away, the story is about modest improvement, not a massive breakout. So where did the real progress happen? Entertainment, which includes streaming. This is the milestone everyone is waiting for. After losing billions, the streaming division Disney Plus and Hulu is finally profitable, bringing in $346 million. Disney Plus now has about 128 million subscribers, and with Hulu, they're over 180 million combined. This is huge, encouraging structural shift. Next is the experiences that Disney offers. This is the powerhouse, obviously, the theme parks, the resorts, the cruise line. They all brought in $2.5 billion worth of profit, up 13% from last year. Even with some timing noise, the parks are still the undisputed profit engine, funding the entire company's transformation. Finally, ESPN Sports profit was up, but that's mainly because of a big loss from last year. Didn't repeat. The core US ESPN business actually saw its profit dip about 7% of its higher costs because of the NBA and college sports right. This is a critical detail to watch going forward. And speaking of ESPN, we finally have a hard date for its big pivot. The full standalone ESPN streaming service is set to go live August 21st. To make sure it has enough firepower, ESPN just closed a landmark deal with the NFL. They're getting the NFL Network and broad red zone rights, which are must-haves for football fans. In exchange, the NFL gets a 10% stake in ESPN. This move massively strengthens ESPN's streaming future as it moves away from traditional cable. What's my final take? First, the streaming profit is real and a massive milestone. Second, the parks continue to be incredibly resilient and funding everything. And third, there is finally a clear path and launch date for ESPN's streaming future. What's worrying me? The quality of the headline EPS number. It was driven by a tax item, not a surge in business, and that can mislead investors. And while streaming is now profitable, the core ESPN business is facing rising costs, a trend that could squeeze margins even after the new app launches. This brings us back to our one big worry. The company is still heavily reliant on the park segment, which is vulnerable if the economy slows down and people cut back on travel. The bottom line, if you only remember one thing, let it be this. Disney's underlying business is improving, and the successful pivot to a profitable streaming service is a huge win. Eye-popping earnings numbers was mostly a one-time accounting gain. The real story to watch now is execution. Can they make the ESPN launch on August 21st a success? And can the park stay strong enough to support the whole kingdom? The magic is returning, but it's built on a foundation that will truly be tested in the months ahead. Thanks for watching. If you got anything out of this breakdown, please hit the like and subscribe to the channel for future breakdowns. See you on the next one.